Imagine logging into your bank account on, I don't know, a random Tuesday morning, and the screen is just flashing red. A notification pops up saying you are overdrawn by $435 million.
Yeah, you would probably have an absolute heart attack.
Right. But then, like later that very same afternoon, you go out and buy a fleet of sports cars in cash. Your boss calls to give you a massive raise, and your accountant sends an email saying your financial health has literally never been stronger.
It makes absolutely no sense. It sounds like a glitch in the matrix or something.
Exactly. But you're looking at two completely contradictory financial realities sitting side by side on the exact same ledger. And the crazy thing is, both are technically true.
Right. And that is exactly what happened to Jackson Financial in the first quarter of 2026.
So, welcome to today's deep dive. We are digging into this massive optical illusion today to figure out how a major financial institution can look like it's collapsing and thriving at the exact same time. We're pulling apart Jackson's Q1 2026 earnings presentation.
Yeah, along with their official press release and their incredibly dense SEC Form 10Q.
Yes, the 10Q. We really want to understand the hidden mechanics here, like how modern retirement wealth is actually managed, how these companies handle massive global risk, and how they pivot their entire business models right under the public's noses.
The documents from this quarter are just the perfect case study for this because the numbers are so wildly divergent. I mean, let's look at the headline that would cause that initial
The
panic.
big red flashing number.
Exactly. For the first quarter, Jackson reported a U.S. GAAP net loss. So GAAP, meaning generally accepted accounting principles, that loss was $435 million.
Ouch.
Yeah. That breaks down to a loss of $6.24 per share. And for a bit of context, in the same quarter the previous year, they reported a $35 million loss. So on paper, the bleeding seems to have accelerated dramatically.
Right, it looks terrifying. But then you keep reading the exact same earnings report, and they are openly boasting about returning $257 million to their shareholders in just a 3-month window.
Right, which you don't do if you're going broke.
Exactly, and they highlight this massive surge in retail sales. But the craziest part to me is they report their adjusted operating earnings at a positive $361 million.
Yeah, a total flip.
And if you strip out taxes and certain notable items, their earnings actually jump to $5.94 per share, which is an increase from a year ago.
It really is wild.
Whoa.
But to understand the actual health of the institutions holding the public's nest eggs, you really have to look past those headline GAAP numbers. The gap between the GAAP net loss and the adjusted operating earnings is, well, it's where the real story lives.
You know, this whole situation feels like a farmer claiming they had a catastrophic money-losing year solely because the premium on their crop insurance policy went up.
Oh, that's a great way to put it.
Right. Like, meanwhile, they actually had a record harvest. They sold more crops at the market than ever before, and the cash is sitting safely in the bank. The crops are selling beautifully, but the paper value of the insurance makes the entire farm look like it's on the verge of bankruptcy.
Yeah, the crop insurance comparison captures the dynamic perfectly.
I just need to understand why the GAAP numbers force the business to look so terrifying when the core operation is clearly generating cash.
So, to see why the accounting creates this nightmare scenario, we have to isolate two specific items in Jackson's reports. They call them net hedging results and market risk benefits.
Okay, hedging and market risk.
Right. So Jackson's historical bread and butter business is selling annuities, specifically variable annuities that come with heavily guaranteed benefits.
Like promises of guaranteed lifetime income or guaranteed death benefits for the retirees who buy them?
Exactly. They are legally on the hook for those guarantees. They can't just cross their fingers and hope the S&P 500 always goes up.
Right, meaning no matter what the stock market does, even if it drops by 30%, Jackson still has to pay that retiree.
Yep. So they are required to protect themselves against catastrophic market crashes. To do that, they go into the derivatives market and buy complex financial instruments to hedge against that volatility.
Like buying insurance.
Massive, multi-billion-dollar insurance policies against a market downturn.
Which honestly seems like basic responsible risk management. But how does buying insurance translate into a $435 million loss on a quarterly report?
Well, it comes down to how U.S. GAAP accounting rules force companies to report the value of those hedges. GAAP requires these specific derivatives to be Mark to market.
Mark to market, meaning what exactly?
It means at the end of every single quarter, Jackson has to take a snapshot of the current immediate market value of those hedges. And that's regardless of whether they actually cash them in or plan to hold them for decades.
Ah, I see where this is going. If the stock market is actually doing really well, the value of an insurance policy against a market crash is naturally going to drop.
Exactly, which is the ultimate irony of mark-to-market accounting for life insurance companies. When the broader market is stable or rising, the short-term value of their downside protection plummets.
Wow. So GAAP forces Jackson to record that temporary drop in the derivatives value as a massive loss on their official income statement for that specific quarter.
Yes, it essentially forces them to capture the volatility of a moving roller coaster in a single static snapshot.
So it is entirely a paper loss. The farm is doing great, the cash is rolling in, but the snapshot of the crop insurance policy looks incredibly ugly this quarter.
Exactly. And that is why they present the adjusted operating earnings right alongside those GAAP numbers. That positive $361 million figure, that strips away the accounting noise.
It removes the wild swings of the derivatives.
Right. And it shows you the actual cash being generated by the underlying business of selling and managing those annuities.
Which brings us to a really crucial pivot in their strategy. Because their operating earnings aren't just strong because they're selling more of the same old products, right?
No.
The underlying type of business Jackson is doing is undergoing this massive transformation. When you look at the sales numbers from this quarter, it tells a story of a company completely shifting its engine while the car is driving down the highway.
Yeah, let's look at those sales figures, because they represent a really deliberate move away from the exact volatility we just discussed. So total retail annuity sales saw a huge jump. They were up 31% to $5.3 billion for the quarter.
31% is huge, but the composition of those sales is totally inverted from their historical norm. Jackson has traditionally been a top 3 heavyweight in traditional variable annuities.
Yep, that was their empire.
Yet in this quarter, their traditional variable annuity sales actually dropped by 6%, down to $2.5 billion. So their core product is shrinking.
They are actively moving away from products that carry those complex lifetime living benefits. The guarantees on those older variable annuities are exactly what forced them to buy the massive, expensive hedging programs.
The ones that create all that GAAP volatility.
Exactly. They want less of that.
So if they're letting their flagship product shrink, they have to be replacing it with something else to get a 31% overall growth rate. And looking at the breakdown, the growth is coming from a very specific pivot.
The RILAs and FIAs.
Right. Their registered index-linked annuities, or ILAs, shot up 68% to $2.0 billion. And even more striking, their fixed and fixed index annuities, the FIAs, skyrocketed by 335% to $756 million in a single quarter.
335%.
Yeah, and a massive driver for that was a newly launched product they called Jackson Income Assurance.
You know, seeing a 335% jump in a specific product category for a legacy financial institution in a single quarter is incredibly rare. It shows a highly coordinated, really aggressive sales strategy.
I have to admit, though, I'm a bit puzzled by the strategy here. If Jackson holds a dominant top 3 market position in traditional variable annuities, abandoning that position seems incredibly risky. Why walk away from the exact product category that built your empire in the first place?
It's a fair question, but it all comes down to the fundamental mechanics of how these different products actually make money for the institution. We are looking at a shift from a fee-based model to a spread-based model.
Okay, break that down for us.
Sure. So traditional variable annuities are largely fee-based. The customer puts their money into accounts that function a lot like mutual funds. Jackson takes a percentage fee for managing the money and providing the overarching guarantees.
It sounds lucrative.
It is, but as we saw with the $435 million paper loss, managing those guarantees requires massive hedging programs. The earnings are just too volatile for a publicly traded company to manage smoothly. Investors hate that volatility.
Which is why they are diversifying into these spread-based products like the fixed index annuities.
Exactly. With a spread-based product, the customer isn't paying a direct, visible management fee in the same way. Instead, the customer hands over their premium, and Jackson promises to credit their account with a specific interest rate or a return based on a market index up to a certain cap.
And then Jackson takes that customer's money and invests it directly into their own general account.
Right. So Jackson's profit is the spread. They make money on the difference between what they can earn on their own investments and the interest rate they promise to pay the customer.
Okay, so if they promise the retiree 4% and Jackson can go out and earn 7% on that money, Jackson just keeps the 3% difference.
That's the spread. It is a much more stable, predictable business model. It completely removes the need for those massive, hyper-volatile derivative hedging programs that plague their variable annuity business. The earnings just smooth out significantly.
But wait, that creates an entirely new problem, doesn't it? If your entire business model now relies on earning a spread, your investment pipeline has to be absolutely flawless.
Oh, 100%.
How does a company reliably find a 7% return in today's market to fund these fixed annuities without taking on an insane amount of risk?
That is the multi-billion-dollar question. Yeah. And it explains the most significant strategic move Jackson made this quarter, their massive 10-year partnership with TPG.
Yes, I was fascinated by the details of this deal. On February 11th, 2026, Jackson officially closed this partnership with TPG, which is, they're an absolute titan in the private equity and private credit space.
They're huge.
And they didn't just sign a standard vendor contract, they structurally intertwined the two companies. TPG acquired a $500 million equity stake in Jackson using Jackson's treasury stock.
Yeah, and in return, TPG issued $150 million of its own common shares back to Jackson.
It is a structural swap. By holding equity in each other, their long-term financial incentives are completely aligned now.
Exactly. And on the operational level, Jackson is utilizing its internal asset manager, which is called PPM America. PPM is actually huge in its own right. They just saw their assets under management grow 18% year over year to $95 billion.
Wow.
Yeah. And PPM is now teaming up with TPG specifically to access what the industry calls investment-grade asset-based finance and direct lending.
We should probably define what asset-based finance actually means in this context, because Jackson has a massive $54 billion investment portfolio backing these annuities.
Right, and they are highly conservative with it.
94% of that portfolio is investment grade. Even within their $9.7 billion private debt portfolio, they limit their exposure to below investment grade debt to a mere 1%. So they aren't just throwing retiree money into high-risk venture capital.
No, definitely not. So asset-based finance and direct lending simply mean lending money directly to companies or projects outside of the traditional public bond market.
Okay, so instead of buying a publicly traded corporate bond...
Right. Instead of that, TPG might originate a direct private loan to a successful mid-sized company or finance a massive tangible asset like a real estate development or an infrastructure project.
Ah, got it.
These are high-quality investment-grade loans, but because they are private and less liquid than public bonds, they offer a higher yield.
So you basically have a traditional legacy life insurance company handing over a $500 million ownership stake to a private equity firm entirely to get priority access to these private loans.
Because that private credit pipeline is the absolute lifeblood of the new Jackson. Think about the pressure created by that 335% surge in fixed index annuity sales.
Oh, right. They have all this new cash.
Jackson has thousands of new retirees relying on them for competitive guaranteed fixed rates. To offer those rates while maintaining their strict investment-grade safety standards, traditional public bonds simply do not offer enough yield anymore.
They need exclusive priority access to the private credit markets?
Exactly. It's a perfect symbiotic loop. TPG has the infrastructure to originate these massive, high-quality private loans. Jackson desperately needs the yields from those loans to back their booming annuity sales and lock in their profit spread.
And in return, TPG gets a massive, steady, highly predictable flow of capital from Jackson's retail customers to fund their next decade of deal-making.
Yep. They have completely rebuilt their engine, they restructured their sales to focus on stable, spread-based products, and they secured a Wall Street pipeline to fund those specific products.
So we have the sales strategy and the investment strategy, but what does all this complex financial engineering actually achieve for the holding company and its shareholders? Because at the end of the day, all of this restructuring has to produce tangible results.
Well, the result is an incredibly efficient machine for generating free cash flow. Yeah. When we look at the actual cash generated, the optical illusion of that $435 million GAAP loss completely shatters.
Right, back to the cash.
Yeah. In the first quarter of 2026, Jackson's free cash flow shot up 35% to $288 million. Their holding company liquidity is sitting at nearly $650 million.
Which is a massive stockpile, especially considering their required minimum liquidity buffer is only $250 million. They are swimming in nearly $400 million of excess cash.
And they are aggressively deploying that excess cash. As we mentioned earlier, they returned $257 million to their shareholders in just 3 months. That was $192 million in share repurchases and $65 million in dividends.
That's incredible. But the ability to confidently funnel that much cash out of the company requires us to look at the internal plumbing detailed in their 10Q. They rely heavily on what they call captive reinsurance companies.
Is like the captive reinsurers.
The documents specifically name Brook Re, which handles the variable annuities, and Hickory Re, which handles the fixed and fixed index annuities. Now, these are subsidiaries set up specifically to reinsure Jackson's own policies internally.
Yeah, they essentially insure themselves.
Right. I was trying to wrap my head around why a company would insure itself. And it seems like Brook Re and Hickory Re function essentially as shock absorbers on a car.
You know, that analogy actually works perfectly when you look at the mechanics of what these captive reinsurers do.
Think about it like this. The shock absorbers don't change the actual road you're driving on. The road represents the stock market, the interest rate environment, consumer behavior. It's inevitably going to have massive potholes and speed bumps.
Right, you can't control the road.
But the shock absorbers ensure that the passengers inside the car, meaning the holding company and the shareholders, don't feel the violent impact of every single bump. It allows the car to keep driving smoothly forward, generating cash, even when the macroeconomic road gets incredibly rough.
That's exactly it. By using these internal captive reinsurers, Jackson is permitted by regulators to use a modified U.S. GAAP approach. This allows them to align their assets and their liabilities much more closely than standard GAAP allows, which smooths out the financial ride. And crucially, it mitigates severe capital requirements, most notably something called the cash surrender value floor.
Okay, that is a heavy piece of industry jargon.
Good.
What exactly is a cash surrender value floor, and why does Jackson need to mitigate it?
Yeah, sorry. Think of it as a regulatory doomsday scenario. A cash surrender value floor is a rule that requires an insurance company to hold enough liquid capital to pay out every single policyholder if they all woke up tomorrow and decided to cash out or surrender their annuities at the exact same time.
Oh, wow. It is an unimaginably massive amount of capital to keep locked up.
Exactly. It's wildly inefficient. So by utilizing their captive reinsurers, Jackson can legally and safely manage this requirement, freeing up capital that would otherwise be trapped.
It protects their core regulatory capital. The documents refer to this as their statutory total adjusted capital, which currently sits at a very robust $5.5 billion. They also boast about having a risk-based capital, or RBC, ratio of 554%.
Right. And RBC is essentially the ultimate grade regulators give to an insurance company. A ratio of 100% means the company has exactly enough capital to support its specific risk profile.
Yeah.
Anything near or below that, and state regulators will step in and potentially halt the company's operations. So having an RBC ratio of 554% means Jackson holds more than 5 times the minimum capital cushion required by law.
Wow.
It is a total financial fortress.
And that regulatory fortress is the ultimate permission slip. Because their statutory capital is so deeply protected by these internal shock absorbers, the holding company can confidently take that $288 million in free cash flow and hand it straight back to the shareholders via dividends and buybacks.
Exactly. And they do it without ever jeopardizing the promises they've made to their retirees.
When you put all these pieces together, the narrative completely flips. You realize the initial headline is just accounting noise masking a highly optimized operation.
Yeah, it really is.
Let's connect all the dots we've uncovered today. We started this deep dive staring at a terrifying $435 million net loss, a broken compass that would make any casual observer assume the company was in a total crisis.
Right. But by actually reading the SEC filings and the earnings presentations, we tore down that optical illusion.
We found a business in the middle of a massive, successful transformation. They are pivoting their sales strategy away from the highly volatile fee-based variable annuities and aggressively moving toward stable, spread-based index annuities.
We saw how they are funding that massive 335% growth in fixed products by forging a structural partnership with TPG. That secures the private credit yield they need to maintain their profitability.
And we unpacked the internal plumbing, the captive reinsurers acting as shock absorbers that protects their $5.5 billion in capital, resulting in a 35% increase in free cash flow.
It really is a masterclass in why true financial literacy matters. I mean, whether you are an investor evaluating financial stocks or you're just an everyday person holding a retirement annuity, you have to be able to distinguish between a paper loss driven by mark-to-market accounting and the actual operating cash flow of a business.
And more importantly, you have to understand how the yield on your retirement account is actually being generated. The guaranteed interest rate on a fixed annuity doesn't just magically appear out of thin air.
No, it definitely doesn't.
As we've seen today, it is increasingly being generated by funneling retail retirement money into the private credit and direct lending markets through massive Wall Street firms.
Which introduces a fascinating dynamic for the broader global economy. We are seeing a blurring of the lines between traditional, highly regulated retail insurance and the much more opaque world of private equity and private debt.
It leaves us with a critical final thought to mull over. Jackson's pivot is a brilliant business move, but it highlights a sweeping trend across the entire financial sector. Everyday retail retirement products are intricately tying themselves to private, less transparent debt markets to find the yield they desperately need.
Right.
If the comforting illusion is that our guaranteed retirement income is entirely insulated from risk, what happens when reality sets in? If the future of the everyday retiree's nest egg is now fundamentally dependent on the success of private Wall Street credit markets, what happens to the everyday retiree if those private markets face a systemic shock of their own?
Yeah, that is the real unhedged risk hiding beneath the ledger.
Definitely something to think about the next time you check your retirement balance.